Good afternoon, everyone. I wanted to make a quick video to give you an update on exactly what's going on in the financial and the banking system right now. I know there's a lot of fear and a lot of contagion about our banks collapsing. What is going on with the three banks that we've seen collapse so far in the last week and change, and what's happening with my money, and what is the government doing to protect my money. Stay tuned. I'm going to give you a detailed report of exactly what happened with Silicon Valley Bank, how they collapsed, and really what the federal government is doing to ensure that your deposits are safe. So really quick, if this is your first time seeing one of my videos, I ask that you please smash that like button, please hit the subscribe button and ring the bell so that you can get an update each time I post a new video. I post things all about the stock market, all about investing, and all about everything financial and estate planning. So now to today's topic, we're talking about Silicon Valley Bank, Signature Bank, Silvergate Capital, all these financial institutions that have seen trouble, especially one that's seeing trouble today, which is First Republic. All of these financial institutions have something similar in a similar caveat or similar tenet that they have in place. All of them have a significant or had a significant concentration to one industry or one particular client. Specifically speaking with Silicon Valley Bank, they are in the Silicon Valley of California, which there is a lot of tech and VC venture capital startups. Now, what took place with them is they had a lot of investments in U.S. Treasuries and mortgage-backed securities that had resets when interest rates started to rise. That allowed their capital liquidity ratios to drop significantly. So as a result, they were forced to sell and liquidate some of these securities at market prices, which gave them a significant amount of losses on their balance sheets. So in order to do so, in order to rectify this issue, they had to raise capital. So they started looking for investors. They started looking for capital infusions from other entities to prop the bank up so that it will be able to make good on its deposits to its customers. Unfortunately, they were not able to do so in a timely fashion. That capital adequacy dropped significantly. And with that being the case, we are in an era where information transcends very, very quickly. Through Twitter, through Instagram, through Facebook, there was a lot of messages that were transcended that talked about the bank being insolvent and not being able to take care of its deposits. So that created the bank run that we haven't seen on the bank in several decades. This was the largest collapse of a bank that we've seen since Washington Mutual that took place in 2008. However, the Federal Reserve and the U.S. Treasury did step in and provide a joint statement saying that they're going to backstop all of the deposits of SVB, Silicon Valley Bank. Now that's above the FDIC limit of $250,000. This was done by the Federal Reserve to really stop the contagion in the market of potential fear and potential run on other banks out there. Although this was done, it not necessarily stopped the fear that's in the market. The stock market has continued to plunge when it comes to regional banks and when it comes to the banking sector overall. I would say this. The national banks, the larger banks such as Bank of America, Wells Fargo, JP Morgan Chase have not seen the same amount of volatility as the regional banks such as Signature Bank, such as Silicon Valley Bank. So that is a positive. When we start to see the contagion and the runs on the bank like we're seeing right now with the smaller regional banks, are just these few small regional banks, if we start to see that on the larger banks, that could potentially cause some more economic shifts and some more economic trouble that could take place in our economy. So another thing that the Federal Reserve did was they opened their short-term lending facility and stretched it out for a year. So banks are now able to go to the short-term lending facility and borrow against the Federal Reserve for a year's time frame. And what this essentially did was it allowed them to reprice the loans are in the investments that these banks have, whether they're mortgage-backed securities or U.S. Treasuries, allow them to be repriced at par, which took a lot of the negative or a lot of the ancillary unknown volatility off of the balance sheets of these banks and allow them to have somewhat of a healthier stance going forward on their balance sheets for the next year. One thing that is different about today than it was about 2008 when we saw a financial crisis before, the Great Recession, is that back then there was financial calamity surrounding mortgage-backed securities and surrounding all the exotic investments that banks were in and the leverage of those investments. We were unsure how deep and how wide that moat was for all the banks that were out there. We did not know how deep the mortgage crisis was going to be or how deep the real estate crisis would be. What's different about today is we are very transparent in understanding these negative investments are the negative impact that these investments that Silicon Valley Bank made on their balance sheet. They're easily quantifiable as there are U.S. Treasuries and mortgage-backed securities that were easily transparent and easy to see. So unlike 2008 and like the Great Recession that we saw in the past, we don't foresee cataclysmic declines or cataclysmic default across the banking sector and all. So I would assure you that for all sorts and purposes that the financial system is still operating, is still safe, is still secure. That doesn't mean that there isn't any unhealthy banks that are out there. But I would encourage everyone to understand what the FDIC limits are. Although they have extended those limits in this temporary situation to cover all deposits for Silicon Valley Bank, that's not necessarily going to be the case for every bank. As we remember, back in 2008, not every financial institution was bailed out. There were some that were bailed out, but not all of them. So I would encourage everyone to maintain $250,000 and below in your account balances, because that is the FDIC insurance as of right now. Now, I know that's harder for many of those large tech companies out there, many organizations who may have $250,000 in daily transactions. So I do presume that as a result of this, we'll see more regulation and more conversation around a difference on the FDIC insurance for banks as opposed to individuals. Thank you so much for tuning in to this video. Please like and subscribe to this channel. Ring that bell so you can get an update each time I post a new video. Thank you. Have a great day.